To regulate or not to regulate, that's a question that the country is grappling with as the Digital Lenders Amendment Bill goes through the motion. And the question is it good to regulate digital lenders in this country? Good morning and welcome to Biz Check. We are live from Broadcasting House. My name is O'Brien Kimani, and this is a question that we shall be grappling with here. And of course, I'm joined by Tala, Managing Director for East Africa. That is Ivan Mbowa. This is the issue that is at hand. If I can give you a quick brief, whereby the National Assembly has published a bill that seeks to regulate interest rates that is offered by mobile-based applications like Tala, like Branch, and so much. And there has been a lot of hula-baloo as to whether this is the right move to put them under the ambit of the Central Bank of Kenya. Of course, we have seen a Central Bank governor saying that it is high time that the operations of digital lenders are put under CBK's purview, and there has been a lot of backlash, of course, from some of the digital lenders. And the question is still not yet off the market on whether to regulate digital lenders. Joining us this morning, I told you, is Ivan Mbowa. He's the Managing Director, Tala, East Africa. He's joining us to help us put this thing into perspective. Thank you very much, Ivan, for finding time to be with us. First of all, you see, you have tremendous knowledge of fintech, having worked with some of the leading fintech giants in the world. You have exposure with Citibank, one of the largest banks in the world. You have also worked with what's the name of the fintech? Umati, yes. Yeah. Your exposure comes with some form of experience. When you look at the digital lending market in Kenya, what conclusions do you draw?
I think the digital lending market in Kenya has gone through a significant evolution, and it's actually very young. Many people must realize that it began maybe 7 years ago. And actually, the first...
Around 2014, yes.
Yeah, 2014. The first player really was Mshwari. So Safaricom, together with NCBA, launched their first sort of banking and savings product. And then you had Tala coming in as the second player. In fact, Tala was one of the first non-bank fintechs in the market. And 7 years later, we have over 300 plus fintechs. We have served millions of Kenyans and actually done a lot of tremendous good. But with the growth of the industry, there have been some challenges. And I think this is what's really led to calls for regulation. Naturally, the majority of the players are actually not regulated. And I would say the majority of players have actually upheld professional standards of conduct. But you have had a few cases where, unfortunately, you see a couple of players potentially engaging in what I call unprofessional and not consumer-friendly practices. So, for example, if a customer is in default, they're calling a customer's contact list, right? And I think that's actually absolutely unprofessional and should not be allowed. Or you potentially have very, very aggressive, debt collection practices. You have some players who have not provided clear contract terms. So I go take a loan from you, but I have no idea how much I'll end up paying, when it's due. If I have a problem, I cannot reach your customer service. So because of all those reasons, I think that has sort of led to both the central bank governor and also members of parliament saying, okay, we have sort of witnessed this idea go from a baby and now it's sort of growing up, but we realize that if we don't give it some guidance, it's likely to go out of control.
In most cases, and this is a global standard whereby it's a global practice whereby you have a lot of technological evolutions being ahead of regulations. But we have seen a situation whereby we've gotten to a point whereby now the government is saying, hey, look here, we need to get down there and try to see what exactly are fintech doing in this business. And the question has always been, do you place fintechs under the regulations of CBK?
That is actually the big question. And I think that we as an industry have been a little concerned about that. I think that we agree with regulation, and we've always sort of been rather open as to who is the best regulator. Today, the central bank regulates banks. Banks are institutions that will go to individuals, ask for your deposits and your savings, and then go ahead and lend it to others. That is very, very sacred and very complicated work. And that's why they should be regulated. I think we've been concerned about, are we going to be subject to the same rules as institutions that are taking on a lot more risk, especially the public's money? In our case, almost the entire majority of all digital lenders are actually using their own capital. So they go out to investors, they essentially create a business plan and say, well, this is the need we see in the market, this is the product we think we can launch, can you please fund us? And they use that capital to lend to customers. And if customers don't pay them back, well, that is shareholder capital that is lost. So I think we started thinking, is the central bank the best regulator? Could there be a need for the creation of a new regulatory body? But given where things have reached in terms of the parliamentary process, I think we're on board with the fact that it does appear the central bank will be our regulator. And now we just want to make sure that there is an understanding that perhaps they cannot use the same rules for banks and deposit-taking microfinance institutions as they use for non-deposit taking fintech.
Of course, I mean, central bank governor has been very clear, saying that, look, fintechs are not to be classified as commercial banks, because they are not in the business of deposit taking.
Correct.
They're just in the business of lending funds.
Yeah.
And so they're going to have a subset of rules to regulate how your operations are of course, carried out. And the reason why we got here, and you put it quite well, is some of the players embarked on some unethical practices whereby the rules of the game were not very clear even to the borrowers. And so you end up a situation whereby borrowers are paying as much as up to 400%, on loans. That's according to a report that was published by the Financial Sector Deepening. So this absolutely negated the fact that there should be some form of regulations. But we have seen a situation whereby the Digital Lenders Association of Kenya are saying that, look here, we don't have any problem being regulated, but can we also be given a chance to regulate ourselves? But how do you regulate your own game where you're participating as a player?
I know that has actually sort of come across as a relatively controversial statement that has been made by the Digital Lenders Association of Kenya. But
of which you are a member.
Yes, in fact, actually Tala is a founding member.
You're a founding member.
Yeah. It's not so controversial idea as it may seem. In fact, if you look around at the world and look at how other countries sort of regulated players like this, what self-regulation actually means is that you may have, hypothetically, the central bank as a designated regulator could say, okay, we're going to sub-allocate, or actually we're going to, in many ways, designate some of our authority making to your association, and it could be limited. It could be, we'll give you the authority to maintain the official register of all players. You will, determine a code of conduct which all players must adhere to. But in the event that players do X, Y, Z, they will face consequences from ourselves. So it's not necessarily that you're saying, okay, digital lenders, go ahead and regulate yourselves. It's more of saying, how can we work with the official regulator to delegate some of their supervisory powers? And this actually can be very cost effective, even for the taxpayer. Right? If you think about it, it would mean that you're able to leverage industry resources to do some critical roles without necessarily going to the taxpayer and saying, we want to create a new department, we're going to need more allocations. And so this is really what we mean by self-regulation. It is saying what part of the responsibilities that the regulator will have can be delegated to an industry body.
You see, even when you look at the banking sector, I mean, there is a grouping of financial sector players. You have, for example, the Kenya Bankers Association.
Correct.
But their role is not a self-regulation. Their role is to bring all the players, under one roof, so that they can embark on proper advocacy, as a group, so that they can also set standards. This is how we're going to operate in the market. What is so hard about digital lenders or fintech, operating under such a model?
In fact, actually, the Digital Lenders Association in Kenya today is very similar to the Kenya Bankers Association. It's the primary, industry representative body. In fact, as a group, we have been able to meet with legislators, we've been able to meet with potential regulators, including the central bank. It allows government to understand how can we, communicate with one body who's representative of the many. I think that while there are things we can borrow from the Kenya Bankers Association, I also do think that when we look at global best practice, there are also things that we can, potentially expand and go further. We shouldn't necessarily be restricted to precedent. yes, this is how the banks behave. But as I said earlier, banks and fintechs actually have divergent risks that they present to an economy. You know, a bad fintech, at worst, will most likely lose their money. A bad bank will lose the money of depositors and even cause potentially a lack of faith, or worst case, a run on banks. So this is why I think that there's some avenues where, yes, we can borrow from the Kenya Bank Association, but we don't have to be restricted to what banks have done.
You see, this morning we are discussing the issues around fintech, of course, the financial. Inclusion has been a key, being driven by fintechs in this country, and we of course have seen a situation whereby the number of banked Kenyans has increased from a low of 26% about 10 years ago to the current almost 90%, and this has been largely driven by fintechs. So, in as much as we talk about, you know, the negative sides of fintech, it's always good to be objective and look at it also from the positive side of fintechs. And that's the discussion we are having here with Ivan Mbowa. He's the managing director for Tala, East Africa. And I'm also urging you, if you have a history with fintechs, good or bad, I want to give you a platform so that you can also share with us your experience. At KBC Channel 1 is our Twitter handle, and at O'Brien Kimani is also my Twitter handle. Get to share your information with us so that we can also discuss it right here with Ivan Mbowa. He knows a thing or two about fintech, and of course that's why he's here, helping us to put all these things in the right place. Mbowa, we are talking about regulations. Help us understand or create a picture of a post-regulated industry, fintech industry in Kenya.
Yeah. I think a post-regulated fintech industry will have a couple of attributes. One, there will most probably be a drastically reduced number of players. Today we're over 300. In fact, we don't even know the right number.
Yeah.
In a post-regulated industry, you will know the right number. Similar to how you have a similar number of banks, you'll be able to go onto the central bank website and essentially say who is licensed to actually participate in the business of being, let's say, a digital credit fintech. With that, it's also likely that the central bank will probably introduce some minimum capital requirements, which is to say, if you are in this business, you are required to have X amount of, you know, investment capital on your books. Doing that will also most likely reduce the number of players, because fintechs range in size. You know, you have effectively, you could launch a fintech today out of your garage, right? With, you know, a few 100,000 shillings. You know, in the future, you will realize that there's a lot more standardization. I think in a post-regulated environment, we'll also likely see a path to which fintechs are allowed to participate with credit reference bureaus. As you might be aware, last year at the height of COVID, non-bank fintechs were restricted from being able to list defaulters with credit reference bureaus. We do believe that, you know, post-regulation, there'll be a path back. And then also, I'd say from an industry perspective, I actually expect to see a lot more diversification around products, which is to say, right now, you look at the 300 players, it's actually very difficult to distinguish one from the other. They're all effectively giving somewhere between 21 to 30-day products, which are typically up to 30K or 40K, and you know, it looks very, very standardized. But once we're regulated and competition heats up, right, there are fewer players, which means there's more opportunity to capture market share. I actually expect to see a lot more innovation, which is good for the consumer, ultimately.
There are also accusations that some of the players in the fintech industry, because there is no proper regulation as to where you get the source of your funding from. I mean, some of the players may be involved in money laundering, in proceeds of crime, proceeds of terrorism. As an organization of digital lenders association, is this something that you're also concerned about?
As the Digital Lenders Association in Kenya, that's actually not, let's say, a risk that we have seen. We understand, of course, the central bank has talked about this in the past, so perhaps they have, you know, reasons to believe that maybe there are a few players in this market who don't have legitimate source of funding. I'd say that as an association, we welcome having enhanced scrutiny, right, around who is behind our members. We believe that we have nothing to hide. If anything, you'll find a, you know, a rather standardized ownership background.
This, of course, I mean, there's also been a concern, you know, from also the international organizations, like the United Nations, like the Department of Justice Department in the US, and saying, look here, this is something that you need to look into. You don't have a situation whereby anybody can just jump on board and start offering money to people, of course, at a cost. And with the regulations, do you see this coming to an end?
I was surprised. I haven't heard of the UN and US Department of Justice concerns on fintech in Kenya, but I do think that once you have enhanced scrutiny around who is behind fintechs, it will address any sort of money laundering risks that the central bank perceives, and potentially it probably will lead to fewer players. I think, depending on the requirements that the central bank puts up and saying, what you have to prove, some people may decide to shy away. I think the vast majority will actually come hands clean and say, this is who we are, this is how we operate. So I think it actually could be beneficial for the industry.
I mean, of course, it's proper to say that I mean, some of intelligence brief are not shared with the players. Of course, they are shared at a certain level, and so from where you sit or from where you stand, I mean, you may not be privy to some of the information.
Correct.
But the beauty about journalists is that they also get to understand and to get to know some of this information, and so. With more than 300 plus players in a market of 50 million Kenyans, do you believe that this market is saturated?
Personally, yes, I'd actually say so. I think that you don't need those many amounts of players in a single market. In fact, I do think that while I'll tell you some of the benefits of having a lot of players, it'll drive innovation, right? There's a lot of competition, which means that ultimately we're all competing to get the consumer to choose us. But one of the biggest downsides to the growth that we're seeing is that over the past 7 years, there are a case of too many players offering too few Kenyans too much money. Which means that, as everyone is trying to compete to get market share, you effectively have a situation where I would say, maybe a few years ago, the average Kenyan might have had 4 mobile apps on their phone. We're looking at data from TransUnion. They released a report recently on mobile credit in Kenya. That went from about 4 apps on their mobile phone. I think it was 2018. And 2019, that was about 8 apps on their phone. Last year, that was an average of 12. Right, so effectively, we're talking about a situation where Kenyans have access to 12 lenders. Their income has not increased 12 times, right? Which really means that ultimately, I do think that sometimes the unrestricted growth of the industry in terms of number of players can also have some downsides in terms of, well, if people are offered money, they will take it, but it doesn't necessarily mean that they're able to repay it. And that's actually not a positive for the industry.
Let's, for example, take the case of Tala. I mean, you offer your loan, of course, at certain conditions. What are the conditions, for example?
Well, I can probably start you off with access conditions. So you have to have an Android device, which is what 90% of Kenyans have, 95%. You have to download our app on the Google Play Store. And once you download the app, in order to access credit, we will ask for permission to data that you have on your device, because we use that data to actually determine whether we can lend you and exactly how much we can lend to you. And once you accept that, you are typically approved. An initial limit that will range from about 1,000 Kenyan shillings to maybe 5,000 on average for most borrowers. And then as you begin the relationship and you repay your loans, that will grow to about 30,000 shillings. As of now, you can choose your tenor. In fact, we're actually launching a feature where you'll actually choose exactly how much you want to borrow and for how long. So you could potentially choose between 7 days to maybe going up to 60 days. And depending on the risk that we classify you, your pricing will also range, right? And so those are effectively the conditions of sort of access to the product.
But for now, the longest loan tenure is 30 days?
30 to 60 days, yeah.
30 to 60 days. Let's first of all look at that whole process. I mean, the process starts by the customer having an Android phone
Correct.
or an iOS
Correct.
phone.
Only Android, unfortunately. We can't
Android.
serve iOS. Yeah.
And Android, for Kenyans, it means a smartphone. That's all.
Any
smartphone.
Techno,
Techno, whatever brand. Then you go to the terms of getting a loan facility, and one of the conditions is that you have to give Tala, the go-ahead to access your data. And so that's where the point is, or that's where you have the concerns. How much data do you get access to, and what do you do with this data?
So in terms of data access, I think one of the first things I should say is we only request as much data as we need to make a decision.
How much is that? Or what kind of data would you need?
Perhaps I can tell you that, yeah. How much, it's hard to quantify, but we will look at device data. So for example, I'll give you a rough example. If you have a Techno phone that costs 5,000 shillings versus a Samsung phone that costs 40,000 shillings, that can tell us about your income, your ability to pay for things. That's a signal. We will look at...
but that phone can also be a donation.
Potentially, but for the vast majority of people, they're not so lucky as to have top of the line Samsung donations all the time. We will look at the data you have, potentially looking at your SMS data as well, and we're really just looking to see, are you a bank account customer? Because you can look and see, do you have bank SMSs? Are you an M-Pesa customer? We will look at are you connected to other Tala customers as well, which is also a good signal. We can essentially see, are you already connected in the network of Tala customers? And a wide variety. I'll give you another interesting piece of data. We've looked at how do you save your contacts in your phone book? Do you save them with first name, last name? We've typically seen in the past that, borrowers who save first name, last name, as opposed to just one name, tend to actually have a higher repayment. There are so many signals and the reason why I said it's very hard to quantify is we have looked in the past at between 5,000 to 10,000 data points to actually help us determine, can we lend to an individual? And I know it sounds, almost astonishing, but you have to remember when Tala started 7 years ago, 99% of all people we lent to had never had a formal loan, which means that they had 0 credit reference bureau records. You couldn't just go and say, okay, you want to borrow from me? Let me ask the credit reference bureau about your borrowing history, who you're with. They were essentially in the dark. And so it meant that Tala had to really create a very unique way of saying, how do I determine whether I can give you 5,000 shillings if no one has ever lent to you? And that's why we started looking at strange things like, well, how do you save your contacts? And are you a bank account customer by looking at your SMS? So I know there have been concerns around data access, but I'll tell you that it's actually a positive to the customer, especially when you don't have a record of formal borrowing. I'd say 7 years down the line, that situation is changing in Kenya. In fact, as I mentioned early on, if you have the average Kenyan with 12 mobile apps, more likely than not, unfortunately, you will find a record. Right, they have borrowed with one of the fintech apps there, so it is relatively easier for us to now see what their history is. But in short, we only access the data we need to make a decision as to whether we can actually lend to you.
And who determines the data that you need is actually yourself?
Yes, correct, yeah.
Help us understand these. So the agreement is between O'Brien and Tala.
Correct.
That you can access my data. And what are the safeguards that you have put in place to ensure that third parties do not have access to the data that I have shared with you?
Tala is actually one of the first lenders to create a client data agreement. So you actually see it on our website. Even before the data privacy bill was passed in Kenya, we always actually had an agreement with customers saying, this is how we use your data, this is the rights that you have, this is what you can request us to do. I'll tell you that we have some of the strongest and strictest information requirements, meaning even a Tala staff member cannot access and see the data that you provided in your application. Meaning, so if I talk about all the SMS data and everything, well, first of all, we having millions of customers and tens of thousands of data points is this. There's an incredible amount of data that's available, but to your question, there are incredible safeguards in Chinese walls where this data is kept, and in fact, we have 0 human involvement when it comes to determining how much I can lend to O'Brien. That's effectively done by what we call machine learning credit models, right? Where we've essentially trained algorithms to say, okay, when O'Brien applies, go here to his device, pull this information, weight it as so, and then give him a score. And if he meets the score, give him this loan.
And this is what we call artificial intelligence.
Correct. Yes.
A credit scoring.
Correct. Yeah. So no humans involved, and so that actually protects your data. It also protects us from bias. I don't want a situation where I'm like, I like the name O'Brien. Let's give O'Brien 5,000. I don't like the name Ivan. Let's deny him. There's no human bias involved. It's fully on machines.
So, who is liable for prosecution in case there's data breach of O'Brien?
Well, actually, as per the new Data Privacy Bill and Data Protection Act, Tala, as a sort of data controller and data processor, would also face essentially liability in terms of breaches, just as any other sort of data controller and processor would, right? So in the event that you find that your information has been used in a way that is contrary to what you signed up with when you accessed our product, well, we would be at liability.
You see, in the year 2020, that was last year, we saw the EU Parliament saying that, hey, look here, the AI-led credit scoring system is not foolproof because there is also a lot of human intervention along the process. And so it can't be said that the whole process is secure from end to end because there's still a lot of human intervention in the process. And so how do you remove human biases in the process?
I think it's an evolution, and I'd say it really depends on how you use AI. But for us as Tala, there's zero human involvement in determining the credit worthiness characteristics, i.e. determining what data we look at. But what the humans will decide is to say, if O'Brien scores 0.7, let's say, on our credit score, should we give him credit or make it sure that he has to score 0.8? So this, humans will determine, once the machines give us a score, what portion of our population do we want to make credit available to? They will determine, it's really a situation where I'd say the machine learning gives us data to make better decisions, but we cannot interfere with how the data is created, right? It's just automatically fed. All we can look at is to say, if we have these results, what do we do then? Do we say yes, no? Do we cut back O'Brien's limit? Do we advance him forward? Do we offer him this? But that's pretty much the extent of it. So I think it really depends on how you're using it. And so as much as the EU has seen that it's not perfect, I wouldn't go so far as to say it's a perfect process, but I will say it does involve humans when it comes to actually determining whether O'Brien gets access to
credit. But the bottom line is, it's not a perfect process. It's prone to error. Definitely.
Correct. Almost like everything in life, yeah.
Let's also look at, the issue of, the borrower. You definitely know that almost 40% of Kenyans are considered to be illiterate, or they can't read and understand at the same time. And the people who are in that value chain of borrowing between 1,000 and 5,000 shillings, most of them would fall under this category. And so, even before you sign anybody into your credit portfolio, do you first of all understand whether they have read and understood the terms and conditions?
Financial literacy is actually an ongoing concern, and very legitimate that you called it out. It's actually something that not only fintechs but even banks struggle with, right? Which is, many times there is a strong clarity on I need credit, but not such a strong clarity on what are the terms that I'm going to face to access this credit.
But you see, the beauty about banks is the fact that they have a know your customer, KYC, what you call KYC, whereby, yes, I may apply for a loan, from a commercial bank, but the bank takes time to understand who is O'Brien, what have you been doing with your money, what is your history with money. Do you take that kind of time? And that's why sometimes, when you apply for a commercial loan, it can take you between a week to 3 weeks to 3 months.
So what I will tell you is that KYC is not unique to banks. We do exactly the same checks. So for example, most of KYC is around validating, are you who you say you are, right? Are you really O'Brien? And so we're able to validate and ask O'Brien, well, if you give me your national ID, I can check it with the government database, IPRS. I can look and determine what you've done with your money by scanning through your devices and maybe CRB records. In fact, I'd go so far as to say that banks taking 3 weeks to determine whether to give you credit is a sign of inefficiency. It's not a sign of thoroughness. It's a sign of legacy systems that cannot move fast enough. That's the truth.
How long do you take before you can process a loan?
It's less than a minute. So once you've entered in all your data, once you've entered all your data and you hit submit, you're immediately scored. And that's the beauty of not having humans involved in the process. And all those checks that banks do, we can do in an automated fashion.
Of course, when you look at the conventional way of banking vis-a-vis the fintech, the way they do their business, there are lessons that can be drawn by both parties. And of course, conventional banking system has its own challenges, and one of them is, of course, the know your customer process, because it can take a bit of time.
Correct.
Because of documentation that is needed. But on the other hand, you have a situation whereby fintechs, it can take you between 1 to 10 minutes before your loan is approved, which is, of course, very efficient. But there are also risks in that whole process. Like, you may get the data or the information about O'Brien wrong, and in the process you may burn your fingers. So how do you mitigate against such scenarios?
And that's a good point. There are risks that are attached to the efficiency that I talked about, right? The fact that we can determine whether you can access credit in a minute. I'll walk you through some of the risks that we have. I think one is making sure, are you who you say you are, right? There have been a few isolated cases of identity theft, where, say, O'Brien's brother steals O'Brien's phone and his ID, but effectively make sure that the loan is dispersed into his M-Pesa wallet. So O'Brien takes the liability, his brother takes the money, right? And those are things that we're working with even the telcos like Safaricom to sort of find solutions around how do we ensure that we are mapping out the risks. If I'm lending to O'Brien and I'm using O'Brien's credit history and I know his ID, I'm also ensuring that I'm putting money in O'Brien's mobile wallet. Another risk that we actually have is, does the customer understand how to use this money and repay it in a way they'll not end up in default? And that's actually a real risk that goes with almost all digital lending. And don't forget, the banks are also in this fintech game in partnership with Safaricom. You have Mshwari, KBC M-Pesa, Feliza. These are, by and large, the top 3 largest fintech products. I'd probably say they have 85% market share in Kenya, right? So when you talk about fintech, it's just these 3 players. One of the things that we try and do, and tie to your financial literacy point, is to make sure we show customers this is how other customers have used our loan and repaid it and grown their limits. Recognizing that everyone learns differently. You can't necessarily just have a text in the app and say, please read this, whether the customer can read. So you'll find within our app, you'll have video, you have all different types and forms of media. We also rely a lot on sort of customer referrals and know that customers speak amongst each other. So we try and make sure that they're, we call them Tala champions, who are customers that have used our funding successfully. And, we essentially highlight them in our social media pages, make sure other customers essentially know, why are they champions? How have they actually successfully navigated using this app and using these loans and not caught themselves in trouble? Because I will be honest with you, I think with speed and anything else associated with human beings, instant gratification is not always aligned with the best decisions. Right? If I can get something just as quickly, I probably won't think as thoroughly as to how best to use this.
We're talking about accessing customers' data, and of course now we have the Data Privacy Act here in Kenya. So the issue of data and how it's managed and regulated now somehow has been dealt with by law. But as financial technology companies, you're still in possession of tremendous amount of data for Kenyans, bearing in mind that more than 12 million Kenyans have, in one way or the other, interacted with lending apps. How do you safeguard this information? Because it's huge.
No, I mean, safeguarding customer information, I think, really starts with understanding what do you need the data for, right? And as a result, what data do you need? When can you delete the records, i.e. when is this data no longer useful for you? And if you cannot delete it, who has access to it and under what conditions? So I think when you have a really tight framework around managing information, then you actually have data well protected. But I would say that, data is everywhere. People are using data everywhere. If I think about if I'm on Facebook and I'm scrolling through the news feed, and suddenly I see an ad for a holiday in Mombasa, but it just turns out that I was talking about going on holiday. Well, how did Facebook know to show me, a Mombasa holiday ad? And you'll find that even the large tech giants effectively have even more data. In fact, fintechs have a small sliver of the data that you have in your life, but that's not necessarily a bad thing. In fact, data, when used well, is actually intended to create a very personalized experience for the customer. It is this idea of, the customer wants to be given the right offer at the right time for the right problem. You don't want to necessarily go into provide and be shown 3 generic products which maybe have nothing to do with you, where the institution has not done their homework. So I'd say that access to customer data is entirely meant to enhance the customer experience and give you that sort of white glove, let's call it the white glove experience of they know exactly what I need when I need it. However, that being said, of course, we must also safeguard against people misusing that data, right? And I think misuse of that data is really around selling it to third parties. And that's one thing that we as Tala and even the Digital Lenders Association of Kenya, we've been very clear about in terms of that would be unethical behavior and also really against the law has recently passed.
As Tala, for how long do you hold a customer's data before you can dispose it?
It varies, right? So I think, and I'd have to sort of go into the specific categories, but on average, I typically say about 7 years is the average period where data is typically held, even by banks and institutions, and then after that, it's typically disposed.
It is disposed.
Typically, yeah.
Help me understand here. What is the rate of default among fintechs?
So the rate of default among fintechs is actually a little hard one to pin down, and I'll tell you why. It's an unregulated industry, right? So we don't even know how many players there are. They're not necessarily reporting their data through to any single central body, right, that is aggregating it. But what I can tell you anecdotally, right, from what I have heard, seen, and also in our own experience, is that the rate of default amongst the experienced fintechs that have been in this game for 5-7 years, is actually not too far from banks. It's relatively aligned, and in fact, there are a few players where the default rate might even be better than the banks. So you're talking about a range of, let's say, 10 to 12%, right? I think that's really the best of the fintech industry. But if you're a newer player and you are coming in late into this market, you're trying to aggressively acquire customers, there's a very real risk that you are burning your fingers and you're experiencing default rates that could even literally be 100% and drive you out of business, right? So it's a very complicated business to be in. It's easy to give money, but the challenge is getting it back, right? And that is actually what digital credit's about. Right?
You see, rarely would anybody go to borrow money with the intentions of not repaying. Very few people would do that if they are any. In a situation whereby right now the Central Bank of Kenya has said it is illegal for credit reference bureaus to share information with third parties without the outright consent of Central Bank of Kenya. So what do you deal with the defaulters?
That's actually an interesting one. So once digital lenders who are not banks were restricted from going ahead to negatively list borrowers, it actually meant that we had to default to an old school method of debt collection, which is really anchoring on the relationship aspect with a customer. Right? As you correctly said, there are hopefully few customers who set out to default when they're taking a loan. But if you don't have any stick, right, to use in the event of default, all you're left with is carrots, right? Which is effectively saying, how can I incentivize this customer to repay the current loan? Maybe by telling them what will happen in terms of the next loan they'll be approved for. And so this is really a way in which we've been able to actually navigate without access to this right to list defaulters on credit reference bureaus. It's all really about just emphasizing the relationship and using more carrots because you're out of sticks. Yeah.
So, Tala, what are you doing to, number one, to ensure that you suppress the rate of default, and number two, you lend more to people because you're in the business of lending. That's your core business. Correct. But at the end of the day, you don't want to lend to people who are not going to pay. And on the other hand, your hands are tied as to the most drastic measures that you can take, and one of them is, of course, telling the whole world, look here, this man is not a good borrower.
Well, as Tala, what we've done, and we've seen over since 2020 to date, is a shift in strategic focus to how can we deepen the relationship with existing customers, right? What new products can I provide to them? How can I increase their limit? How can I encourage them to continue paying us back? And that has come really at the expense of potentially reducing the amount of first-time borrowers that we're going to be willing to interact with. We're spending a lot of time really thinking and improving our underwriting tools, this machine learning tools of determining who to lend to, because actually debt collection begins from the beginning, right? The best debt collection is choosing the right customer in the first place. So we've also spent a lot of time enhancing our tools and making sure that we are becoming even tighter and even more precise on who do we choose to lend, because as we know, when it comes to worst case default, we're likely to have to write off these loans if we've not selected the borrower correctly from the beginning.
What is the future of digital lending in Kenya?
The future of digital lending in Kenya is very exciting. Kenya has been a pioneer in mobile money and also related digital finance. I continue to sort of think that Kenyans will innovate further. What you can expect to see is, generic products now becoming niche products. Today, if you access a loan, whether you are employed, whether you're in business, there's not much in the way of specifications for your needs. In the future, I think we'll see players saying, you know what, we're a digital lender focused on business. And we have very specific business digital credit products that are structured as follows. Or we are a digital lender focused on employed, salaried individuals. And likewise, so you'll see more niche offerings. I think you will see consolidation, as I talked about earlier, with regulation from 300 to fewer than X players, which will mean greater competition. I think Kenyans will be the beneficiaries. I think you'll see lower pricing. The pricing that many people have spoken about associated with digital credit is a function of also the rate of default that happens. But I think as the industry matures, as also customers begin to understand how best to use the products and products are designed better for customers, we are going to see rates go down. And I expect that, at some point in time, digital credit will be the only credit available. All the banks will effectively have a digital offering. And in many ways, while it looks like right now we are a niche kind of player, we're in many ways just leading what will eventually become the status quo, how banking is done.
Very well. Before I let you go again, what is the experience of digital digital lending in Uganda, bearing in mind that you're from Uganda, vis-a-vis Kenya, where you're operating now?
Well, in Uganda, it's very nascent. I would say that, the equivalent of Mshwari just launched maybe 3 years ago, 4 years ago. I'd say that Uganda is possibly 5 years behind where Kenya was from a digital credit perspective. It's a very interesting market for players who wish to sort of discover untapped markets with a lot of demand. It's different. Mobile money penetration is growing, but not as deep as it is in Kenya. You don't have a situation where 90% of adults have a mobile money account. But there is just as high a need. Banks don't lend, right? So I'd say it's very exciting. It's a very exciting place for anyone considering new markets.
Yes, risk averse as they are here in Kenya.
Yeah, absolutely.
Very good. Ivan, I have to let you go.
Thank you.
Thank you very much for joining us here, for your insight, of course, and for sharing your time with us.
Thank you.
Your time is highly appreciated.
Much appreciated.
Ivan Mbowa is the Managing Director of Tala East Africa, joining us this morning to help us understand the role of fintech, regulations, and, of course, data sanctity here in Kenya.